So my name is Jonathan Brogard. I am a graduate student at Northwestern University. I'm going to be the moderator for this Q&A session. We are very fortunate to have three great representatives up here, both from the regulators, the institutional investors or buy side, and the algorithmic traders and high frequency traders themselves. So before I formally introduce themselves, I thought I would maybe lighten the mood because this is HFT. It's a pretty serious topic. It's pretty dense. So I was going to tell a joke, like my father would do anytime he would present, anytime I would see him present. But then I realized I'm not very funny, and I don't have any good jokes that would be relevant here. So no joke. Instead, I got one. I'll take that. But instead, I do want to talk a little bit about the motivation for what we're doing here today, and in particular about this panel. And this kind of came up again, thinking about my father. So he talked to me, about how markets worked at probably a relatively young age, like 12 or so. But at that time, the world was pretty simple. You put in your order, you spent like $50 for a trade, whatever your broker charged you back then, and they would give it to a market specialist on the NYSE. That NYSE would eventually place your order, and you would be done. The world has gotten more complicated than that. We've already talked about dark pools, which certainly do not exist in the way they do now. There's been ECNs. There's several different ways of trading. You have different types of trading. You didn't really have algorithmic traders even 20 years ago. You certainly did not have high-frequency traders or low-latency traders. I think Gideon and I we're using different terminology for the same thing. So this panel in particular is going to focus on one particular revelation, and that is high-frequency traders. So as that is kind of a motivation for why we're here thinking about this from a financial regulatory perspective, is because it's new, they're having a big impact on markets, and it's making our world a little bit more complicated to think about. But hopefully it's clarified in the next hour. Okay, so now let me introduce the panelists. We have Amy Edwards on the far end, who is the assistant chief economist for the SEC. She's been in that position since 2008 and has been with the SEC for about 15 years. She's going to be our regulatory expert. Next, we have Adam Nooms. He's going to be our algorithmic trading expert. He's coming to us from Hudson River Trading. In particular, his focus is on new initiatives and business development. So if you want to know maybe the particular algorithm that high-frequency traders are using, I don't think Adam knows it or will he disclose it to you. And on our end, we have Jamie Selwyn, who is coming from ITG, which helps institutional investors work with the market. So he's essentially our buy-side expert. In particular, they are, I think part of their focus is how to operate in the market in such a way that you can not necessarily avoid HFTs, but use them to your advantage. Okay, so with that as a very brief introduction of our three panelists, let me just briefly outline how the structure of the discussion is going to go. My part is essentially done, thank goodness. And so the next part, we'll have our three panelists say a little introduction about themselves, their background, their involvement with high-frequency trading, and then maybe provide some overview insights on HFT. Second, and this is going to be about the next 50 minutes, will be Q&As. So if you have any questions, our three panelists here are here to answer. I'm sure they'll let us know if they're unable to or unwilling to answer certain questions. And finally, that's essentially it. But finally, Paul gave me the okay that I can go past over an hour. So we can, if you have questions, if there's demand for questions, we can take up more time. Dinner's not till 7. Okay, so with that, I'll pass it on to Amy.
Do we want both? Okay, so I'm Amy Edwards. I'm the regulatory expert. And these guys are going to give you a little history of where they worked. The SEC's been around since 1934. So that's about as much history as I'm going to give you. I'm working on market microstructure type issues at the SEC, and I've worked on some high frequency trading issues, including the market structure concept release in January 2010. And I've also been involved in a few exams of high frequency trading firms. And I've been associated with other types of initiatives regarding high frequency trading and markets in general at the SEC. Do you want me to give my quick 5 minutes?
I would love it.
Okay. So one thing that I've learned about high frequency trading is that the particular strategies are not really new. These are the same old strategies that people have been using for years, but it's the timing and the way that these strategies are implemented that it's new. And it's the technology that they're using in order to implement these strategies that's new. Now, they've been talking about low latency and algorithmic trading and the differences between agency and proprietary. High frequency trading is generally proprietary trading, and it tends not to be fundamental. Fundamental trading is much more long-term than what high-frequency traders are doing. Research in general does find that on average, high-frequency trading is beneficial to the markets, but as we noted in the last paper, it's really the extremes that we care about. What happens when we're an extreme in a market? And I'll tell you why that's particularly important, is because high-frequency trading is basically a computer program running a strategy that a human being programmed it to run. And human beings are calibrating these programs using historical data. And historical data tends not to be very good at predicting the extremes in the future. And so computer programs really aren't programmed to handle extremes very well. And so one regulatory issue is, what do we do about the fact that high-frequency trading firms, they're big, they're a huge part of the market, and they're not going to be programmed to handle the extremes in the market? And how do you even define an extreme in the market? So that's kind of one issue I wanted to make. High-frequency trading firms do manage risk. This is very important because, as Harvey mentioned, market makers traditionally have affirmative obligations. And affirmative obligations are not necessarily consistent with being a good risk manager when things aren't going the way you want them to go. And so that's a key issue going forward. Now, if you look at the popular press and you look at a lot of the concerns regarding high-frequency trading, there's allegations of manipulation, order anticipation, or front-running. Now, manipulation in particular is fairly interesting because manipulation relies on this idea that there was an intent to push prices. So if you've got an attorney going out and trying to figure out whether a computer program had intent, then what you're really faced with is a totally different approach to handling those allegations. You have to have people go out and figure out if there's any particular metrics that you need to look at in order to get at intent, or do you have to look at the code itself? And code is not static. Code changes over time. And so figuring out what the code was as of a particular time and having the personnel able to go in and figure out what that code is telling them to do is very tricky. And so the approach from a regulatory standpoint to looking at manipulation is very different when you're talking about high-frequency trading. The last thing I'll mention is the idea of front-running. And front-running is different from just simple order anticipation. Order anticipation, you look at patterns, you try to figure out when somebody is about to trade, and you try to take advantage of that information. Front-running says you know that this order is being placed. And there are allegations out there. And what I am not sure of is if it's physically possible to observe an order that's on its way to a market and still beat that order to the market. It seems to me like it would not be very possible, but there are arguments out there that you can do that. And I guess I'll leave it at that.
Oh, wow. So there was a time when you could do that. That's when the specialist had their feed that allowed them to explicitly do that. Hey, I'm Adam Nunes from Hudson River Trading. A little background on me. I spent about 8.5 years at NASDAQ in their economic research group, I guess for the first year and a half. Then worked several years on the kind of equities product and kind of marrying market structure and technology and regulation. And then for the last 2 years there, started the NASDAQ options market and then worked on integrating the PhilX into kind of the NASDAQ family of exchanges. I joined HRT about 2 years ago and kind of doing business development and new initiatives. A lot of that is focused on U.S. market structure, and we're an active participant in the debate and writing comment letters, on these issues. So Hudson River Trading is a 9-year-old quantitative trading firm. It's a prop trading firm. I think we tend not to call ourselves high frequency trading firm, but I believe we were kind of labeled that. So I think if you're looking for the high frequency trader here, that's going to be me. So I just wanted to give a quick overview of that and then pass it on to Jamie, because I think I'm more interested in hearing what you guys want to hear about.
So we're forced to do this co-location of microphones thing. First thing I would say is to, for the record, state that both Amy's comments and my own are not necessarily those of the SEC. I always wanted to do that. My background, I was actually in the same group at NASDAQ, Frank Hathaway's group. I was under Dean Furbush at the time in the late 90s. Went from there to Goldman Sachs and then to a business called Archipelago, where I was an economist working on essentially some really nascent issues out of which evolved HFT. I mean, sort of the automation of ETF trading, 2000, 2001, et cetera. Started a business called Whitecap Trading, which was an institutional brokerage firm in 2003, which we folded into ITG over this past summer. And ITG is, as Jonathan alluded to, essentially a provider of institutional trading tools. That takes a couple forms. There's a dark pool posit. There's a suite of algorithms. There's high-touch trading, sort of the old-fashioned stuff, which is essentially the human use of electronic tools these days. But I guess I would say that, sort of a lot of my job, it's sort of half a strategy job and half a market structure job, is essentially to go talk to large buy-side investors about things like HFT and how it impacts them. And for the most part, my answer is sort of twofold. One is that it's made markets better, and that's the first thing to say. And the second thing to say is that it's made markets different. And I think that, we heard earlier today, it was Gidgen's comments about how good market quality was in 2008. And I think that's absolutely true. I mean, sort of relative to OTC derivative markets, if you wanted to trade CDS or high yield bonds or muni structures in the fall of 2008, you just couldn't, right? Markets didn't exist. Equity markets were open, every day. They were deep, they were liquid. You didn't like the prices, but you could trade. And I think HFT is largely, to be credited from that. The different part comes into, and if you look at the T-cost data, my colleague Ian Domowitz often does this, in time series, costs have come in pretty nicely over the past decade. And you can fight about, is that automation? I mean, where does HFT step in? But I think it's fair to say HFT is a component of it. The different part comes in, when you think about things like flash crash. And so if we think that costs have come in at the median, what about, higher order moments? I mean, what about the tail risk? And we got a taste of that, I think, sort of on May 6th. And the combination of that revelation, I think, and then the lack of transparency about sort of what HFT is and what it isn't, really speaks to the need for, to Amy's point, for regulators to get more data, to update concepts, to address questions, so we're not regulating the market by what's posted on the Zero Hedge blog or what some consultant says about what HFT is or isn't, but you've got a regulator who's empowered to adjudicate these things. And then also to this forum, the academic community. I mean, the more quality research we have on these questions, I think it improves the market's understanding, and then gets to some of the points Bill O'Brien made over lunch. That it will sort of rebuild or install investor confidence that our markets are not run by machines who are sort of doing anything other than trying to compete to make prices better for individual investors. So with that.
so that's the introduction. Now it's open for questions. Who would like to start? I'll start with a question. So Amy already alluded to this, but it would be nice to hear just a clear definition of what high frequency trading, by what we mean by that. Do we have a specific time horizon? Do we have a number of trades that we care about? What's kind of the definition that we're all on the same terms with?
I mean, I'll give it a whack and then pass it down. I don't think it exists, and I think that's the problem. I think that, when I use the term, and I think buy-side clients use the term, they typically mean modern-day market makers, so liquidity providers, who are updating, sort of beyond a certain frequency. But you can talk to other folks that'll, include sort of stat arbs and even more traditional merger arb strategies that turn over with a frequency that's on the order of minutes and maybe half hours and hours, as opposed to millisecond stuff.
Yeah, I think I agree with that. I also agree, I think Amy hit the nail on the head where she, basically said there's a lot of things that were done more manually that are now automated. And, computers are good at taking kind of redundant human tasks and automating them. So, from my perspective and from HRT's perspective, we really don't think of things like, if you look at the concept release and they have passive market making, stat arb, directional, one other that I don't remember. We really don't think of things in that context. HRT really, is a math and technology focused firm, and we kind of don't really, we believe, fit into any of those boxes. We have people who, kind of think about how to, value a stock, and we tend to do it over shorter time frames, but it's not by employing this method or that method. In fact, I think you'll find that a lot of firms will use combinations of many of these. So I think the paper Gideon presented that talked about low latency trading is probably more accurate, because that kind of gets to how much you care about speed and technology. And I tend to think about that in two ways. There's kind of at the absolute speed, and then there's relative speed, kind of, you versus your competitors. And they both matter in different ways. In one, it's more of a competitive thing where, someone's going to be first and time priority matters, so you would prefer that be you. Or if you're crossing the spread to trade, if there's 100 shares on the offer, only one person gets to lift it. So, that matters. From the absolute standpoint, it also matters. We have to manage our risk, and particularly in the fragmented environment we see in equities, you put out a lot of risk because you don't know where the next order is going. So in order to manage that risk, where you may be quoting across a dozen venues, you don't know where which offer might get lifted or which bid might be hit, and you have to manage your risk across those venues. So in any event, I think that when we look at speed, those two often get confused. I think it's important to just note that they both matter. They matter in different ways.
I guess I would agree that there are a lot of definitions out there. And some of the definitions that I've heard have been going home flat at night. So it's not just talking about using a computer algorithm to generate the orders and to make the trading decisions and to implement the strategies, but also going home flat at night. Now, going home flat at night, if you remember back a few years, that could also describe day trading, and it could describe so's bandits. So that part of it is really not the new part. But it's really just the use of the computers to trade very frequently and to get in and out of positions within a day.
Would you also say that how much the quantity that they hold at any given time tends to be quite small, just a small range around zero, either positive or negative?
I can't speak to that too much, but I know that they're calibrated for risk management purposes, so they use risk management to tell them how much they can hold at any particular point in time.
Yeah, I think you can add, it's likely that you're crossing the zero threshold quite a bit.
I mean, I would just add that I think that's right. I think that was one of the great results of the flash crash report, sort of that when the chips were down, liquidity provision went not by the buy side, but by the wayside, but it was more 50-50 split. I mean, it was essentially, sort of risk came in and risk was dispatched, quite quickly. I think fundamentally that's one of the reasons why the buy side, it's sort of the disconnect. Like they don't, like in days of yore, you could reach out to the block desk at Goldman Sachs, or you knew who the specialist was, and maybe you didn't like his service all the time, but there was a face, there was a name, that you could complain about. And I think the disconnect between the liquidity provider, against whose liquidity you're consuming, who he is, what he's doing, how he's managing that, and frankly, I think everyone understands that they are more risk averse, that these are smaller firms, less capital, but how they're handling risk management and positioning the capital, it's a big unknown, and into that unknown, there are lots of questions and discomfort.
I just wanted to comment on what Amy said. Is that it's true that if you just follow those definitions, then everything falls under them, right? Old market making, new market making. So those definitions are not workable. You can't make regulation that applies to very, very different clienteles. Maybe the idea would be to try to come up with definitions that depend on the profitability of the strategy and the payoff profile of the profitability. For example, if we look at simulated strategy and a payoff versus time versus speed of response goes like this. This is high frequency trader. This is the low latency traders. Without the speed, they can't do that. I bet that most quant strategies, it doesn't go like this. It actually goes like this. The payoff profile, in which case they don't belong to that category. And so hopefully when you have good data, data with trader identities, that you will be able to do things like that. You'll be able to maybe target regulation into that, because without that, then they all look the same. As Adam said, relative speed is extremely important.
Are you referencing relative or absolute speed when you talk about, kind of the things dropping off so precipitously?
At that frequency, at that speed, they're actually the same in some sense. Why? Because let's say that the profitability falls after 1 millisecond. It means that the firms who want to implement that strategy has to have the technology to respond within 1 millisecond. And because the rest of it, they would not be able to be profitable. It's relative because it's the absolute speed, but it's relative because if they don't respond first, or second maybe, they can't make profits with these type of strategies.
Well, I think one of the issues I clearly see in the press, but that I think we all fall victim to, is everyone tends to think of things in terms of U.S. equities because it's better known, and people buy stocks where they're probably not buying bonds or trading on FX ECNs. U.S. equities also happens to be the most competitive market, and that competition has led for U.S. equities markets to be extremely fast and have several hundred microsecond response times. But if you look across prop quantitative trading firms, that's not all they trade. And if you were to look at the CME response times or ISIS response times, they're not as good. And if you then go to a bond ECN or an FX ECN, you're talking about hundreds of milliseconds in some respects. And I know that we have competitors who are trading all those things. So from the relative standpoint, it's still going to matter. Some are more time-based, some aren't. But certainly if you're going to cross a spread and there's, a million euros there and somebody's going to get it, somebody's not, the relative speed matters. But, from my perspective, firms like HRT employ risk management over short time intervals. And, we believe that allows us to manage our risk better than, a firm could have 15 or 20 years ago. So I don't think that that's something where you can just say, we're going to take that tool away. That somehow having liquidity providers who do a worse job managing risk is going to be in the market's best interest seems pretty counterintuitive to me. And that hits on a few other themes that we've seen, obligations and stuff like that, where forcing people to do something they otherwise wouldn't do doesn't seem like that's going to ultimately contribute to stability or market quality. It's, in my estimation, going to either put people out of compliance or put them in a bad position, relative to the risk that they want to take on.
I want to follow up on Amy's introductory comment about the exams. So a regulator has to think about what principles they're going to use to develop their exam program. And one of the things that needs to be decided is the extent to which they're going to look at inputs versus outputs. And at a high-frequency trader, a compliance office has to think about some of these same issues. And so I'm wondering if you could talk about some of the principles that you may use at your own firm in terms of, without details obviously, but in terms of the extent that, to which you can rely on inputs like reviewing code, how helpful that is, or you may be using output metrics such that certain metrics are flags that there may be a problem with the code.
Sure. So HRT is or does operate a registered BD. So I guess from my perspective, the way we approach compliance, there's obviously a major supervisory part of that. But even apart from that, just having like the principles of the registered reps who are actually doing the research into algorithms and coding the algorithms. One of the fundamental things that we ensure that everyone understands is you send an order to the market because you want to trade, not because you want someone else to do something. And that can actually be, depending on how you do your research, really institutionalized, so that you don't look at don't allow them to look at what would someone else do, which would be very difficult to do anyway. But outside of that, there are certain things that you can have within your systems, and one of the good things about technology is if you get something right, you're in a very good position to get it right every time. So there are certain items that are more process, like how do you mark shorts, how do you mark ISOs, there are similar things in options or other asset classes where you can just ensure you have a methodology, you can test that methodology and make sure it works, where that's something that you generally shouldn't have to worry about unless something changes. So I think there's that perspective. Then, beyond that, there are going to be things that you can't do that kind of on the input side, and you have to look at the outputs. So I think similar to any broker dealer, you're going to employ exception reports in order to look at those areas to ensure and feel comfortable that your trading is in compliance.
Is anyone else want to? Yes. Yes.
So I guess it was Jamie started out by saying that he thought that this new environment wasn't very good at handling extremes. And Amy was talking about how humans had programmed these things to start with, and I suspect that humans probably weren't good at handling extremes early on either. It's been a year since the flash crash. That seems like an awful long time in this high-frequency world. So have things changed in a way that now programs have adapted to try to anticipate these kinds of things?
I think that's true, that humans, well, actually, I might push back a little bit of that and say that in times of extremes, humans can stop, right? And humans, and that was sort of if you think about flash crash, one of the problems was, that irrationality continued, there was no sort of stop clause on it. And so whereas the CME bounced, we got to a penny in a century, we got fundamentally irrational things that a human wouldn't have done. Whereas, and it was much more about retail stop orders and internalizers backing away and a certain class of liquidity providers pulling out. Institutional trading desks just stopped trading. So I think that I think what that tells you, and I think this is the SEC and CFTC's view, and the policy making of those folks in the exchanges have kind of put this in action. We need sort of a circuit breaker structure. And so what's changed, has been sort of an iteration of, I think I can list three of them. I may be missing one, so these folks will add if I've missed. A series of single stock circuit breakers, which will evolve into limit up, limit down, hopefully soon. Sort of some very bare bones market making standards to create a safety net, at 8 to 10% outside the NBBO. Some clearly erroneous rules that essentially will say, if accidents do happen, and they may, we can deal with those quickly and efficiently to get things off the tape so people know their risks. So I think that what you've seen is, the exchanges kind of coming together and creating infrastructure that will, allow a stop or a slow down in a joint way when there's a rationality. And it's really tricky, right? Because you've got to, in some sense, you make that policy and you're saying something about price discovery. I mean, you're evaluating the quality of the price discovery. So that the trick is, and hopefully limit up, limit down does this, as Bill alluded to, provide a pause mechanism that can separate the wheat from the chaff. So if something's informational, the pause will sustain and will kick to an auction, and the market can, sort of come off, take 5 minutes to stop, aggregate liquidity, embed the information into the price, open, and then off we go. If it's aberrant, if it's sort of liquidity oriented, if it's noise, I think the debate right now is it a 5 or a 15-second pause, but some sort of pause will allow markets to bounce and go about their business.
So if I could add a little of that, that was actually, I'm glad you said that because I didn't have to. That was one of my notes was, were humans necessarily better? And, we obviously had instances in the past where, it's debatable as to whether or not they were. I think more generally, the thing that is discouraging to me in some of the debate, and certainly not anything that has been proposed and approved, is a lot of the debate was we're going to have to make the market somewhat worse all of the time to make it better, during these extreme times. And I think that's a false dichotomy. And I think Jamie hit the nail on the head where he said what humans could do was stop. So they could stop answering the phone, or the specialists could just widen the quotes out and kind of, effectively halt trading without a trading halt. And that's more or less what we're moving to. But I think we're moving to that in a way where we don't have that trade-off. And I think ultimately if, one of the things that I think Jamie missed, you may have said this, was just having, more concrete, clearly erroneous rules. Things where, there's greater certainty in the market will allow liquidity providers to be more confident staying in. So, there may be some things that come up where they're not, but, I believe in today's environment, firms would not pull out because they didn't know whether or not trades were going to be broken. We have, rules that are what they are, and they've been followed since then. So, we've kind of eliminated that uncertainty. So I think ultimately, not only is it a false dichotomy that we need to make the market worse, I think that having intelligent safeguards will actually make it better all of the time and during those extreme events.
I think one interesting issue that I just want to bring up again is this idea of liquidity providers pulling out. What some liquidity providers did is they didn't really structurally pull out. They switched their systems from automated to manual so that people couldn't automatically get a transaction done off of their quotes. They had to get a manual execution. And so what people who want to demand liquidity and demand liquidity now do is they skip over all the manual quotes. And that's just a logical risk management function for a liquidity provider to do, because it allows them to think and to add a little bit of the human element in there, because you want to think and you want to know that what you're doing is right. It's tough because it's a panic, and we know that human beings don't always work right in a panic, but hopefully we'll be improving things going forward. There is the limit up down proposal out for public comment now, and that would allow markets to bounce back once you hit a price limit, and it's based on a 5-minute moving average. So hopefully you won't hit that price limit very often, and you can't print outside of that price limit, so hopefully that'll take care of some of the clearly erroneous trade issues. But yeah, there's small changes that could probably go a long way.
Yeah, one thing to add to that is, we shouldn't expect that these changes are going to be a panacea. If they were, all good, they probably, they may or may not have been already done. But one of the issues raised by CME in their comment letter on the joint SEC-CFTC recommendations was, what happens when, you know, like a reasonably large portion of an index hits a limit and the rest doesn't? You know, like what's people's ability to price the future, what's people's ability to price the ETF, and then the other stocks that haven't hit the limit in the ETF. So, you know, I'm not sure. I think that's a legitimate issue to raise. Like, we're not choosing between, you know, problems and no problems. We're kind of choosing between hopefully worse problems and somewhat less bad problems. But, you know, I think we're making steps in the right direction. From my perspective, limit up, limit down is strictly better than where we are now. But the good part about where we are now is the exchanges with the SEC coordinating. We're able to get it done very quickly. And it was under the existing framework, and, you know, that was a pretty astonishingly fast response.
Yes.
I'm just curious, most of this high frequency traded market is ISO. Otherwise, how do these orders so quickly cancel their orders without going through the Reg NMS requirement to go to the marketplace and then give you a quote?
I don't really know. I think that it likely depends on what one's trying to do. So, you know, if you're attempting to add liquidity, then you don't necessarily need to use an ISO. You know, if you have a view of what the inside is and you're trying to join the inside or improve it where the spread is wide, then you can achieve that without using ISOs. But I would suspect that, you know, a number of firms, you know, do make use of ISOs.
This is it's an interesting question as it speaks to the point Gideon made, which I don't entirely agree with. I probably get struck by lightning if I did, that agency algos are necessarily behind HFT algos, but I'll agree with it partially in this instance. And it's the use of ISOs. I think we all probably know what immediate cancel ISOs are. Essentially, when you reach out to the 20 bid and say, I'm going to go ahead and take you now, and I know that you may see a 2001 bid away, but that's okay. I've reached out for that. That was sort of an artifact of the old trade through rule. But what was new in NMS, and the gentleman to my right, I believe, may have had something to do with it while I was at NASDAQ, was the day ISO, which essentially was relief for locking and crossing the market. So I'm going to go ahead and lock the 20 bid and become first in line and use the ISO instruction to do it. And there have been a lot of allegations that that this is misused, and that would be an area for regulators to sweep, I think, if they were onto it. It's hard to police, but you could construct, you know, scenarios and look for sort of actions where, you know, if you went and offered the 20 bid, that you had just sort of tried to hit the 20 bid away. But I bring it up because you know, there are folks in the industry who say that agency brokers haven't made effective use of day ISOs, and the reason really is it's a compliance thing. I mean, to put, you know, policies and procedures that your buy side client, and, you know, that you checks and to ensure that your buy side. I mean, I guess you could require that it would come through your systems, but, you know, if you know, ITG was to build a day ISO checker that would incorporate, you know, an action taken, you know, via a CS tool, and there's a lot of complexity. So, you know, I just flagged that as an area, you know, of where some would say there's a structural advantage, you know, sort of, you know, used by the HFTs in the sense that, you know, call it sort of bearing regulatory risk or just being tighter about operational procedures around some of these things. You know, they do it, whereas, you know, we agency guys, you know, haven't made effective use of them.
I guess not. I don't know that, like, quote stuffing, if it exists and if it's a thing, seems like the easiest thing for a regulator to find. and an extremely stupid thing for someone to do for that purpose. You know, I think the initial, I forget the name of the firm that kind of, Nanax, like their initial, like, if that was the case, that should have been found in 30 minutes, right? Like I worked at NASDAQ, I know the tools they have, I know they can find it. So
Is the system, is the capacity of the pipes and the processing so much greater than the people who are using it that this is never an issue? It always reacts at the same speed?
no, I mean, the exchanges have, kind of have their ability to process orders. And, we're fortunately in a world that when they start to hit that capacity, instead of braking, they tend to slow down, which is a better result. So from that perspective, they're built for, the capacity that we saw, really during the financial crisis. And I was there at that time. So I don't really know how one would want to do that. And I'm not a computer scientist, but it's also just computationally, is it cheaper to process things that you know that you need to discard than that you need to process? Unfortunately, and this was a topic that's kind of come up in a few different places, if you wanted to, put your competitors in a worse position, unfortunately, I think you're much better off doing that using not much message traffic, but using misinformation. And, that's, when you get into manipulation, I think you're better off letting everyone think there's 10,000 shares or something on this side and not that side, or, just kind of layering spoofing, which are not new concepts. And then I think the question really comes down to is one of the good things about having automated trading is you have an automated audit trail. But we also need regulators who have the ability to sift through the noise and to find those patterns. So, I kind of view that as, one, incumbent on the regulators to do that. And, from my perspective, it seems like they are doing that. And then two, it's incumbent on every market participant. I see this on the subways in New York. If you see something, say something. Where, if you as a market participant see activity that you think is, is manipulative or is somehow violative, report it. And, that's certainly the approach that we take, and we hope the approach everyone takes.
If I could just add to Adam's point, I'm on the board of BATS, and I think this is true of others, but at least at BATS, the throttling is at the port level. So if you quote stuff, you don't blow BATS up, you blow yourself up. So you blow up your own access point. So it's sort of self-defeating. I do, having had to react to sort of some of Nanax's work, and if you don't know their work, you can go to nanax.com, and they draw these interesting pictures, and they give them these really, really cool names. But when, in my experience, way back when at ARCA, and experience now at BATS, what you find is not really malintent. You find a lot of stupidity. Either A or B, you find a lot of experimentation. And the problem, you get stupidity and experimentation when the cost is zero, right? So it really comes to the, sort of introduces the question of, are the markets, sort of efficiently taxing, sort of these negative externalities that are frankly consumptive of scarce resources and tough to deal with, right? And at ITG, I think we found that the busiest day to record in terms of quote throughput was the middle of the third week in August of 2011. And you say, geez, what's happening? Is Bernanke talking? Did Goldman Sachs blow up? And no, it's just that the cost of stupidity and experimentation is zero. So we need something to fix that. And right. And it happens to be tricky because, and Adam would say this right away, which is that you sort of create the tax on capacity use, and you don't want to impede price discovery. I mean, you don't want to impede some of the behaviors that Gidgen described, around the NBBO, making the price more efficient. What you want to do is when the markets tend to a nickel, sort of the nincompoop who's changing the bid from 5 to 6, through every penny at a velocity of 50 changes a millisecond. It's just not adding anything.
We have a very nuanced view on charges for orders or cancels or whatever. We kind of share a fear that we have a tragedy of the commons that's playing out. I I kind of fear that. I don't necessarily think that's the case. What I think is true is when you have an exchange like BATS or NASDAQ or whoever, that if they have, you know, kind of garbage that's because it's free, that having, you know, some charge for that would be overall a good thing for the market. I feel like right now the competitive dynamic is that the one exchange doesn't want to be the first one to do that. But you know, I also fear even more than the current environment having the government decide what it is. So from my perspective, I do think that the exchanges should charge something. I think that, you know, if I were a BATS board member, for instance, I would, you know, suggest that they start, you know, very low, but have there be some cost. And, you know, we certainly don't advocate exchanges raising the overall fees, but taking some portion of the fees that they earn and allocating it towards orders or cancels or messages, you know, I think makes sense. You know, you then get into some of the suggestions of, well, don't do it on every order because some people have very reasonable ratios or whatever you want to call it. And that just kind of, to me, gets into a more scary territory of, you know, if it turns out that, you know, we have some strategies that are highly efficient and we can couple them with other strategies that are highly inefficient, that when we put them together, oh, it turns out, you know, we're just under the threshold. Or similarly, if there's a clearing firm that aggregates several other firms and, you know, puts retail together with prop, that, you know, it's just kind of creating these distortions that don't make sense and could just be solved by having there be something for everything. So I guess this could be the shocking high-frequency trading firm actually think that's a good idea, but, you know, we do.
Yes, on the specific capacity issue, there, as Mark knows, there are general requirements for the SEC that exchanges check on capacity and make sure that they're prepared. I think there's this idea of the intentional slowing down of the market. I think the bigger fear may be the unintentional, and so the sort of the algo gone wild issue. And hopefully, sponsored access has solved that to a large degree by requiring broker-dealers to run risk checks on all the orders that get submitted through them to a market. And so they actually have to screen every order that they sponsor going into an exchange.
I'm thinking about algorithmic trading and ever shorter time frames, and I wonder the information space that you can use to define a strategy gets smaller as you go to smaller time, and you can process fewer inputs to respond that quickly. So the question to the practitioners is, do you see then a sort of commonality among the strategies that you see being employed? This is across all the traders, and what is your perception of the impact that might have on market quality? Again, the fact that a lot of these strategies may end up being very similar. And for a regulator, do you have any regulatory concerns? Again, if a large portion of the market is working on these same types of algorithms.
Well, I guess the first thing I can say is that it gets back a little bit to one of Gideon's earlier questions, is that defining what a strategy is very difficult for a regulator because whatever you define it as will be gamed. And so just even the simple idea of defining what a strategy is very difficult. Strategies also, when there's the development of a strategy, it's in development for a very long time relative to its overall life. Strategies tend to turn over very quickly, and some of that is because they're taking advantage of an opportunity that goes away as soon as they start taking advantage of it. And I guess I can pass it on to, maybe Adam wants to add something to that.
Yeah, I mean, I guess, you know, I don't know what our competitors do. I think within HRT, you know, we certainly strive to have diverse strategies of our own. But, you know, this is one area where, you know, policy decisions we make can help to determine that. So, you know, one of the things that I'm concerned about is that the push for obligations and the kind of push towards let's have market makers register and kind of rely on them to help some of the volatility, would ultimately result in that. Because if you end up creating an unlevel playing field where if you can kind of fit within this box, if you can quote at the inside 20% of the time, and you can do this or that and trade however many shares, there may just be a certain subset of strategies that can do that. And if it's the case that you end up advantaging those strategies to the detriment of others, you're going to see more of those and less of the others, and you could ultimately harm the diversity that we see in the market, and kind of, to me, make the market worse, because you'll have fewer, less diverse strategies in it, and you'll end up over-reliant on a smaller number of players when you could have encouraged competition and ultimately had the market better overall. And I don't say this from a selfish point for HRT. We're a supplemental liquidity provider on NYSE. Whatever the definition is, I believe we will be able to meet it. I just don't think it's the right direction for us to move in our markets. I think the markets have gotten a lot better as we've moved away from that, and I think we should encourage competition and not kind of fit it into some construct that could even help in the short term but harm in the long term.
So I think you're touching on, to me, the most interesting allegation that's raised against HFT. I mean, you can talk about quote stuffing, you can talk about other things that go bump in the night, but there are folks out there that say that sort of the presence of HFT algos, liquidity prediction algos, there's a herding effect that's impacting price discovery, and that's if true, incredibly bad. And I have personally a hard time understanding how it could be true. So how can guys who are characterized by their predilection for going home flat at night, I mean, how are they impacting price discovery the long term? I don't get it. But there seems to me to be a rich data set, and I've talked to my co-author of long ago, Robert Battaglio, about some work along these lines. I think his view was that it was too outlandish a question to warrant further research. But if you had good cross-sectional data on sort of some proportion of HFT, and you maybe looked at things like the city stock split, or Freddie and Fannie, sort of their various travails, you maybe could tease out some of these questions. And I just bring them up because, I mean, real people, like the head of trading at Kevin Cronin AIM, thinks that HFT is driving correlation, which is in turn impacting the price of stocks, in a real informational way. And that's, to me, a very serious allegation. It would be nice to sort of dispose of it, disprove it, and move on. But it sort of lingers out there.
Yes, Ingrid.
Yeah, I had just a couple comments. First of all, just about so to me, what I think about, obviously, studying high-frequency trade is interesting in and of its own right, and you can have worries about manipulation and behavior that we would like to regulate and so forth, but at the end of the day, I worry more about the externalities on the rest of the market. And so, just about the bandwidth one, Adam, you probably remember when we were at NASDAQ way back when, there was talk about putting cancellation fees at the time. And at the time, that was quickly.
Oh, at the time we did it.
Yeah, but then what happened? Yeah. They're gone. We can follow up later. The one other thing I wanted to mention, though, another externality that I wanted to add, and then I'd be happy to hear all three of you respond to that, is, this quote flicker that Gideon was talking about. You said you cannot even see it with the eye. So to what extent is it actually disturbing market? You saw the quotes being actually better, narrower, depth is more depth, there's less volatility. But what is the sense from the buy side? What is it that causes them to be concerned about the high frequency trade? If they can't even see it, it shouldn't hurt them. And just in perspective, I talked to a guy who's an asset manager for a large pension fund in Ohio, and he's a value trader. So it's like, I could care less if if the price goes up 2 cents or down 3 cents. Forget about sub pennies. I'm buying this stock because I think it's going to go up $10. What do I care if it's 1 penny up or 3 pennies down?
Some people in life are afraid of things they can't see. Yeah, I think if you let's stipulate that there's a reason. I mean, if you were sort of charged with finding reasons to be afraid of things you can't see, one would be, that you've got sort of some algorithmic strategy that's designed to sort of, when you trade with high frequency guys, I mean, one thing you have to trade with high frequency guys because they're everywhere. I mean, they're not 70% of the market or 80% of the market or what the consultants say, but they're significant. I mean, it's well north of 50 or 50, 55. So you're going to trade with them. You want to control the pace at which you trade with them, so you don't sort of betray, your true liquidity demand. And if there was something that was happening, sort of sub-second that you couldn't see, but yet was controlling, so you were sort of trading algorithmically in an inefficient way. And sort of this flicker was sort of allowing the counterparty to tease out your intentions in some way. There's potential for games. And I think that the logical response is for the person afraid of the thing they can't see to sort of have a good tete-a-tete with their algo provider, understand exactly what's happening, go through some scenarios and figure it out. But there's a rationality around some of this stuff, and part of it's just institutional. I think that the nature of the business has changed. I mean, there's been a migration of sort of folks who are, less comfortable with technology, sort of people that are more comfortable with technology onto trading desks, and that's still in process, right? It's not just NYC specialists, it's the buy side too, and so that pops up, sort of all over the place. But I mean, the question is, I think that, those kinds of questions need to be solved competitively with the buy side, sort of getting educated and taking the tool, understanding the tools, and sort of taking matters in their own hands, as opposed to just being afraid of things that they can't see or don't understand.
Yeah. So I guess I have a few things to add. So one is just, I guess, to the externality point. That's, kind of where, for me, we could probably do a lot of good by having some non-zero charge to help to account for that. The second part, though, is when are we going to start to see it really get externalized? We're not seeing the commissions that agency brokers or others can charge go up, and we're not seeing trading costs go up. So at this point, I think you've had a lot of advancement in technology that, has allowed people to kind of not have those raised costs. The other thing that, is one of the policy issues that is important is there's also the case that some people are going to be better at it. When we were launching NASDAQ's option system, there was all this discussion about the opera feed and how it was, something that just no one could conceivably process, and it was so expensive, and we couldn't move to pennies because of that. And we took it in and processed it on one standard piece of hardware. And it just, like NASDAQ was really good at that time. When NASDAQ wanted to charge 10 cents for an order, they weren't good at that kind of thing, and, apparently priced themselves out of the market. So I think that one area is, that's good, and having people have the ability to process data more cheaply or faster or whatever is, should be a good thing. The other piece, to me, comes down to choice. Right? Just because there is all of this stuff doesn't mean everyone necessarily needs to get it. So if you talk about your friend who's a value investor, I bet they care what the NBBO is, and perhaps they even want to see every exchange's BBO. They probably will care that the agent that they use has access to all the data for their execution, but they may not need to see every exchange's full depth of book order feed. That could just be noise to them, and what they're looking at is, this is worth $7. I think it's going to 17. That's a very different decision. What I believe is that having the different time horizons and having the different strategies in the market is what makes it work. If everyone thought that stock that was worth 7 was going to 17, no one would be able to buy it, and it would just be at 17. So having people spend that time and space is kind of what intermediaries are in the market for, and I think we just need to make sure that their participation in the market adds value and makes it better.
I was just going to say that it's a good point about externalities, and I think the quote flicker, to add a little bit to what Jamie said, is the big externality is whether it's driving anybody out of the market. And we do hear stories at the SEC of the quote flickering being evidence of front running, but I think where the real advantage might come would be your work and the work of other people that just looks at these elements that come from high frequency trading and actually tries to look at those externalities and see what's the impact of those externalities. If you can measure whether there's anybody driven out of the market, then I think that'd be very useful. Or if you could measure and publicize whether, quote, flicker is really harmful to anybody.
If I can add one thing. I think the other area, just from a regulatory manipulation standpoint, is, there's one thing for a human being to be able to see it and respond to it. There's another thing for a co-located prop trading firm to be able to see it and respond to it. So, from my perspective, there's been like a lot of talk about a minimum quote life. I certainly don't support that, but one thing that from the regulatory side, it seems like it makes sense to look at is if you're repeatedly sending orders and canceling them before anyone could conceivably respond to them, and you show a pattern in practice of that, then what are you doing, right? And that's, kind of gets to the intent. I feel like a lot of these actions, particularly in high volumes, should speak for themselves.